Let's forget the political headlines for a minute. Today, we're going to look at Venezuela as a pure financial case study. You've got a nation sitting on just immense resource wealth, but at the same time, it's dealing with some really profound economic challenges. So the real question is, what does all of this actually mean for the markets and, for investors? Let's break it all down.
Yeah, so this is the central question we really need to get to the bottom of. When you see a nation's crisis play out on the global stage, where do the market opportunities actually lie? I mean, from a pure risk-reward standpoint, what are the real stakes here for someone looking to invest?
All right, to figure that out, we have to start with the balance sheet. So, first up, let's value Venezuela's resources. Before we can even begin to understand the potential return on an investment, we've got to do a full inventory of the assets on the books.
Okay, the very first asset, and the one we really need to pay attention to, is the most liquid one, gold. Venezuela's gold reserves are estimated to be worth about $21.8 billion. Now, this number is absolutely critical because it represents the most immediate, ready-to-go source of cash to finance any kind of recovery. Now, let's look at a much, much bigger number, but one that's way more speculative. We're talking an estimated $100 billion in coltan, which is a supercritical rare earth mineral. And this is a huge but. That value is completely uncertified, the deposits haven't been developed, and, get this, criminal gangs control a lot of the extraction. So yeah, this is a long-term moonshot, not a quick win by any stretch. Of course, the main event here is oil. But we have to start with the reality on the ground right now. As it stands, Venezuela is only producing about 0.7 million barrels of oil per day. It's really just a shadow of what it could be. And to put that tiny number into some global context, just compared to Iran's 2 million barrels a day or Russia's 4.5 million, it becomes crystal clear that even with its massive reserves, Venezuela is, for now, a pretty minor player in daily production. The big takeaway here is that any political change isn't likely to cause some huge global supply shock, at least not in the short term. So you want to unlock all that potential? Well, it's gonna come at a price. And that brings us to our second section, the true cost of oil. We've seen the asset, now let's dig into the incredibly steep price of actually making it happen.
Not all oil is created equal. Pulling a single barrel of Venezuelan crude out of the ground costs around $25. Why? Well, because it's this heavy sulfuric oil that's just really expensive to refine. Now compare that to Saudi oil, which can be as cheap as $3 to $5 a barrel. This cost difference it's fundamental to this entire story. So, to get production up from that 0.7 million barrels a day to a more respectable 2 million, the country's entire oil infrastructure needs a complete and total overhaul. The estimated price tag for that job? A staggering $40 billion. Okay, so where's that $40 billion supposed to come from? Well, here's the thing. If you look at the big U.S. oil companies, like Exxon and Chevron, their combined cash on hand is only about $21 billion. They just don't have the capital to fund this thing alone. Not without doing something drastic, like halting their dividends or share buybacks. So the only way this really works is by forming an international consortium, basically pooling money from oil companies all over the world. But listen, these investors aren't just going to show up with blank checks. They are going to demand some serious guarantees. We're talking ironclad legal security for their investment, and given how expensive it is to get started, you can bet they'll want some very, very favorable tax treatment. Okay, so let's say they even get the investment money sorted out. There is another massive hurdle they have to clear. And that brings us right to Section 3, a mountain of debt. This is the giant liability just lurking on Venezuela's balance sheet. How big of a liability are we talking about? The country's debt to GDP ratio is an unbelievable 200%. That one number right there paints a really stark picture of just how financially insolvent the country is. Any new money coming in from oil has a very, very long line of creditors already waiting for it. And who's at the front of that line? Well, this chart breaks it down. While international bondholders are owed about $100 billion, the single biggest state creditor is China, with $60 billion in loans. This sets up a huge geopolitical and financial question. Are they ever going to get paid back? So, what does a massive, super high-risk project combined with this complicated debt mess actually mean for the rest of us in the market? This leads us to our next section, the ripple effects on markets. Let's connect the dots back to global liquidity. The most immediate consequence is a multi-billion-dollar liquidity drain. I mean, think about it. That $40 billion has to come from somewhere. That means it's going to be pulled out of financial assets, stocks, bonds, and put to work in the real world, rebuilding Venezuela's infrastructure. It's like a giant vacuum cleaner sucking cash out of the system. So naturally, this begs the question, what does this huge shift in capital actually mean for your portfolio? Let's break down the potential impacts on a couple of major asset classes. For stocks, this kind of liquidity drain acts as a headwind. With less cash floating around to chase financial assets, it could definitely limit the upside for the big indexes like the S&P 500. To put it simply, that money now has another, very different job to do. But on the flip side, this whole situation creates a potential tailwind for gold. Why? Well, remember that $21.8 billion in reserves? That's the main piece of collateral for any new financing deal. That, plus all the general uncertainty, just reinforces gold's role as a key safe haven asset, which would likely support its price. So you have this huge investment in physical assets, a major capital shift. But this isn't happening in a vacuum. At the exact same time, we're seeing another really significant move in the financial world, but this time it's in digital assets. And that brings us to our final section, the Bitcoin breakout. This is another key trend that every investor needs to be watching. I mean, listen to this quote. This captures a massive shift in thinking. When the CEO of a major traditional bank comes out and says something like this, it signals a really profound change in how the big institutions feel about crypto. And this growing acceptance is a huge part of what's fueling this recent rally. And you know, the technical charts seem to back up this bullish story. Bitcoin has recently smashed through some key resistance levels, which suggests that long, painful, bearish trend might finally be over. Plus, if you look at the charts, you can see a long period of accumulation. That's where the smart money has been quietly buying in. These are all classic signs of a major trend change. So, what does this all mean in real numbers? Well, if you combine that growing institutional buy-in with this new technical strength, some analysts are now setting a potential short-term price target for Bitcoin right at the $100,000 mark. And this leaves us with a really critical question for every single investor out there. We are seeing two powerful forces at play right now. This massive need for capital in real-world physical assets like we just talked about in Venezuela, and at the same time, this explosive growth of digital assets like Bitcoin. Figuring out how these two huge trends will interact and where the smart money is going to flow next, well, that's the key challenge for all of us in the years ahead.